Welcome along to our first time buyer mortgage advice presentation. I'm joined here by my colleague Ryan Flood, and I'll introduce myself and Ryan momentarily. I suppose just to give you a brief overview of what we're going to try and get through today. We're going to try and keep it short to the point. This is your lunch break, and we hope to only take maybe half an hour of your time. And we want the information obviously to be very relevant, but we also want the information to to be sharp to the point, and hopefully you'll come away from this presentation with a better understanding as to what you need to do to put yourself in a position to buy your first home. Simple as that. Okay, so we're going to go through the before, the during, the after, and let you know about kind of the process and what you need to try and tee up. Okay, um, my name is Colin Whelan. I'm a certified financial planner. I've been with IPF for roughly 11 years. I'm in the industry about 15 years. And as I mentioned, I'm joined by my colleague Ryan Flood. Ryan has roughly about 11 years worth of industry experience. Ryan has worked as an underwriter, which is really a great experience for any mortgage advisor to have. Look, Ryan has been fantastic since he's come on board with IPF, and we're delighted that he's actually with us, and he's been helping our clients to achieve their objectives from a mortgage perspective in the short time he's been with us. Who are we? We're an Irish-owned brokerage. For those who don't know, we were formed in the mid-90s. And we have a team of financial advisors that is growing and growing and growing. And that's great to see, because obviously we're doing something right. We're amassing clients, and obviously have quite a considerable amount of monies that we manage for our clients. And we're delighted to continue to provide a great service to our clients. And part of that is the first-time buyer experience, the mortgage experience. So that's enough out of me. That's enough from me. Oh, sorry, actually, before I move on to Ryan, there are a few important things I just need to say to you. We will do a Q&A session, okay? And the Q&A session, you can put your questions in, and we'll pick out as many questions as possible, and we'll answer them as best we possibly can. And also as well, we are going to do a quiz, okay? There is a voucher for €100. And basically what we'll be doing is we'll be asking a question that's in relation to the content that Ryan is going through today. Okay, so we'll be doing a quiz on that, and we'll be announcing the winner here today, so you'll know whether or not you've won by the end of this presentation. Okay, so please stay tuned. Okay, Grant. So look, Ryan, I'll hand over to yourself. That's okay.
Yeah, sure. Thanks, Colin. So what we're going to do today is I'll just run through the quick agenda of what we're doing. So the topics on choice will be to why you choose a mortgage broker, the mortgage types and process, the documents required, rules, regulations and fees, the mortgage journey itself, a couple of points on do's and don'ts. We'll do the prize draw, and then we'll do a bit on what happens next, essentially. So just to kind of start us in then as well is why you would choose IPF. So one of the reasons people tend to choose IPF, essentially from the public sector side of things, is just the knowledge we have of the public sector. It just allows us to understand how your salary works with your increments, additions, and the way your salary scale works. So we have in-depth knowledge of that. What that would do is it would help us with the lenders. So each lender has their own different rules on what they do on your salary scale. So it just means we're able to actually point you in the right direction, get the most of what you can get, as opposed to just going off what your basic salary is. What we have is market experience. So as Colin said, I've been working in the industry a long time. Over that time, I've built the knowledge of all the different lenders we have access to. We'd have access to all the main lenders and non-bank lenders as well, who would lend for different reasons. So the experience is there. For life is essentially, it's the public sector offerings. So with ourselves, we would have a full suite of products, not just the mortgage side of things, but it's all just in relation to the public sector. So just making sure that you are looked after and it's a one-stop shop. And then the personal touch is essentially just knowing the lenders is what they do with your income, how they'll assess it, how they'll review it, and what are the pros and cons of working in the public sector when it comes to the mortgage side of things. For yourself with the first time
Ryan, can I just ask a quick question on that, right? Because
Sure.
I think it's a relevant question, right? So can you just give us an example of like someone that I suppose we've helped in the public sector to achieve a higher loan amount? I believe that there is something that we can try and do to help anybody who's working for the public sector in that regard.
Yeah, so just after starting, I was going through the current case files, essentially to see who and what, touching base with the clients. I spoke to a client who wasn't particularly happy with the maximum loan that they got at that time. The reason being is that the lender they went to wouldn't actually go up the salary scale for them, whereas we found a lender that would actually go up 3 times up their scale. So what that done, it just allowed them to buy more, increase their purchasing power, so that when they actually did go out and view properties, it meant they had a higher variety of options available, and they actually end up requiring the higher amount in the end, just with the way house prices are kind of going at the moment.
So just to recap that, then we're able to look forward, like so if someone's maybe on say 50,000 euros at the moment, but in say 3 increments time, or maybe say 3 years time, for example, that could be 50,000 up to 56,000 euros. Well, then we're actually able to go to a lender and say, look, this person's on a certain pay scale. It'll, that person's salary would be 56,000 euros in 3 years time. Can we use that 56,000 euros to our advantage and give that person a higher loan amount, which then maybe allows that person to go and buy the house that they want to go and buy. Would that make sense?
Yep.
Yep.
That's it in a
That
nutshell, essentially. So, like, even though your increment only went up 6,000, when you're looking at borrowing, you can borrow a certain multiple of that. So it
right.
means like it might only be 6,000 on paper, but it could be potentially 3.5, 4 times it, depending on your current circumstances. In this
So
case,
nearly an extra 25,000 euros worth of purchasing power, nearly.
exactly, without having to
Yeah, which is
save.
big. Okay, great.
So,
Okay, perfect.
so in terms of first-time buyers, then these are just a few points that I'd kind of run over. So I'd always recommend having a discussion 6 months before you apply. So the reason being is that lenders look back 6 months over your activity on your current accounts, your employment, and all of that. They'll be able to utilize up to 4 times your combined salaries. So if you're going as a joint applicant, it'll be both salaries essentially multiplied by 4. That'll give you an indication as to what the max you could get. Overtime will be accepted. Again, it falls under the same type of thing with the salary scale, where sometimes one lender will accept half, some will accept more, some will accept all of it. It's very dependent on, again, the lender, but that's where we come in. With yourselves, you do require a minimum 10% deposit. So that can be made up through savings, gifts, sale of assets, anything like that. Once you provide your 10% deposit, as first-time buyers, you have a number of different schemes available,
Let me
all of which
stop
are
for a second there. Sorry,
sure,
don't get annoyed at me, right? But we have a good question that's coming in, right?
sure.
And so just the question is the annual bonus considered in the income calculation?
Yes, so that would fall under similar to overtime. So the reason I
Okay,
mentioned overtime specifically here is that with public sector, a high majority of them would be overtimes as opposed to bonus. But with
okay.
bonus, just because you work in private sector or public sector doesn't mean
Yeah,
the next person does. So bonus falls under what's called variable income. So overtime, bonus, commission, all of that would fall under variable. All of
okay.
that would be assessed differently based on the lender. Some lenders have caps, some don't. So again, it's the benefit of having access to six that allows you to kind of spread it over to show each and what lender would do.
Okay. Okay. Cool. And then just I have another question here as well. It kind of
Sure.
maybe falls in the same area, but
Yeah.
like obviously we're dealing with people. We deal predominantly with people in the public sector. There might be people here from the private sector today, and that's fine. That's absolutely fine. We can help people within the private sector, and obviously people in the public sector may have spouses or partners who work in the private sector. So this question is quite relevant, maybe for private sector workers. But how does being recently self-employed, how would that impact upon things, Ryan?
So it'd be very dependent on the line of work you're in. So if you completely change your employment field, then it's a bit more difficult to say it's a continuation of your current employment. And at that stage, you're probably looking at a minimum 2 years self-assessment before you could look at a lender. If you're someone like a doctor, dentist, or an advisor type role, so if you're like financial advisors, they're quite common to go from PAYE income, so like your standard employment, to self-employment if you're going as an agency or brokerage or anything like that. So the way it works then is you'd have to have at least one return done,
Okay.
but we can save a year essentially for the mortgage. And the way your income is assessed, it'll be assessed based on your PAYE income and on your self-employed income. So normally you go self-employed, your income goes up. So that's generally more beneficial then as well.
Great. Okay, brilliant. Just to say, Ryan, we have a load of questions coming in, and I'm trying to. It'll be impossible for us to get through everything, guys, but I'll try and
Yeah,
get through as many of the questions with Ryan as possible.
yeah. And jump in at any stage because it's always easier answering the question when it's relevant on the slides and just
Great.
makes it easier to understand. So in terms of the schemes available, so like you have your help to buy. So essentially what that is, it's a large government tax refund based on your income tax or dirt payments over the last 4 years. Again, you can go into detail on it, but it's capped at 30,000 per person. You have your first home equity scheme. So that's when you sell a percentage of your property to the local authority. You have to have a minimum 10% deposit in order to avail of it. But again, that's when you go into the specifics on it. And then you have the affordable home scheme. So that's similar to the first home equity scheme where a percentage of it is owned by the local authority, but you buy the property cheaper essentially with a bit of a discount. All of those schemes are specific to new builds or self-builds. So they're very limited to an extent. I'm sure you know the price of new builds. So
Mm.
if you are looking at utilizing those, you can make the application for Help to Buy immediately anyway, without any requirement. Because what it does, it just gives you an idea of your budget, which is one of the most important parts of the mortgage. You need to know how much you have to contribute to the mortgage, and then you know how much you need to borrow. A lot of lenders will then have kind of offerings. So one of them will be like your cashback offering. So for generally what people use it for is to kind of furnish the house, take a holiday after the fun process of a mortgage. But it's more or less just an offering from the lender to generate a bit of business on their side. And then you have a combination of a number of different rates. So you'd have your fixed rate, you'd have your variable rate. So fixed rate, you're basically signing up for a period of time for a specific rate. Variable rate, it allows you to kind of go with the market, whether the rates are going up or down. We'll have a discussion in relation to what's more beneficial to you. So at least then you
Mm.
know whether to go for one or the other.
I think usually like the fixed rate tends to be like give you that certainty, doesn't it really? Like,
It guarantees what your payments are. So as a first time
yeah,
buyer, the house is going to be your largest purchase of your life at that
yeah,
stage. Might change then if you move at a later stage, but to begin with on your first time buy, yeah, it's you're not going to spend two, three, 400,000 on another car or something like that,
yeah.
hopefully. But with the repayments, they're going to be your largest payment per month. You have rent and stuff like that, but you'll always have your backfall. Whereas with a mortgage payments, the obligation is there to ensure that you have those payments there. So it's just making sure that you know what your payment's going to be and you're not having to worry exactly what they are. But another main point of it is don't make sure the mortgage payments takes up your whole life either. So you want to make
Yeah.
sure they're comfortable enough to still have a life afterwards. There's no point buying a house if you're never going to leave it.
What is it? I just got back on that because I remember like
Yeah,
buying my own home like so a number of years ago. But like we looked at those fixed rates and those variable rates, and the fixed rate was really stood out to me. And the rationale behind it was just it gave me certainty. I understood then like what was going to be going out. And I think I did a 3 year fixed rate, Ryan, if that makes sense.
yeah,
And it really gave me certainty like of okay, well, here's my outgoings for the next number of years, and
yeah.
it just helped me to plan. And obviously, like hopefully, your career goes well, etc. You get a few pay rises, and then you can try maybe like look at like how best to use that money going forward in the future when you kind of have a bit, get yourself sorted out. If that makes sense.
Yeah, it's more or less, it's just once you start out, you just want to kind of give yourself a bit of certainty so you know how your accounts look
Yeah, sure
because
thing.
it's more just kind of better safe than sorry.
Yeah, sure, okay, cool. I have a few more questions coming in, right? So I'm going to ask you another
Sure.
question on that there, right? So someone actually asked a question. So we obviously touched upon the Help to Buy scheme there. Sorry not to bother you with that, but the
Yeah.
Help to Buy scheme. So the help to buy, it can't be part of your deposit. It's not possible to make it part of your deposit. Would that make sense?
No, it would. So Help to Buy is there to assist you with the purchase. So if you're buying, let's say, a new build property for 300,000, you
Yeah.
get the maximum 30,000 available. Then all of a sudden your deposit is covered. You just need to cover your additional fees. So if that's the case, then you could potentially be mortgage ready without actually knowing.
Okay. Okay, good stuff. Okay, excellent. Okay. Okay, great. No other questions there on that one just yet, Ryan. I'll let you kick on.
Yeah. So as we're going through it, there's a little QR code in the top right as well. So if you do want to kind of scan that, you can fill in the appointment questionnaire and stuff like that as well. Just kind of get yourself top of the queue because I do know there is a large volume on the call at the moment. So it's more just kind of making sure you get all your questions answered in time, just in case we don't get to them during this webinar. I'll continue on. So I'll just go through the typical documents that you need. So as I said, it's a 6 month review, essentially what the lender does. So they'll look for your current account and your savings account for the previous 6 months, which would be including your Revolut, N26, Bunk would be another online saver or any accounts essentially with your name on it. They'll require a salary cert, so just a specific template that they do or don't accept. We have a template that we can send out there when required. You just send it on to your HR department and they'll be able to complete it. If you're in departments like HSE, Department of Education, they have their own templates. So I'd always recommend just ask, just in case, so you don't miss out. Because the salary cert can take a bit of time, because if it goes somewhere like the NSSO, they have a large volume of departments that they look after. So that could be a reason why your application's delayed, essentially going to submission. You require 3 months of your pay slips. So majority of people, if they're monthly, it'll be your last 3 consecutive. If it's fortnightly, your last 6, and weekly, your last 12. Your employee detail summary. So what that is, that's just your P60, confirming what income you've got. If you are looking, as you said, for bonus income, overtimes or anything like that, they do require a track record. in order to accept it. So they'll probably look for your three most recent just to confirm it. Your proof of ID, proof of address, so driving license, passport, and then a utility bill, bank statements. And then anything case specific, you're probably looking at marriage certs, divorce agreements, anything like that that you'd be looking at. Just on mentioning the divorce. So like when you're a first time buyer, there is a recategorization of that. So like if you were previously divorced or previously separated from having a mortgage in a joint name, you do qualify as a first time buyer again, and you
Okay.
can qualify of the benefits on it. So if you know anybody that's in that scenario, that's becoming an issue for them, they can essentially qualify to assist them because they will be classed as a first time buyer again.
Okay, cool. Okay. A few more questions for you, Ryan, coming in just on
Sure.
that last slide. It's all right. I think this one, yeah, like so. I know this one resonates with me actually because I can remember, as I said already, like getting my mortgage a number of years ago, and the amount of paperwork required that you've
Yeah.
like obviously gone through there, right? It was it's just it can be a bit of a pain, right? That's what I remember about it. You're trying to get this together, you're bothering certain people trying to get so what systems do we have in place to try and make that simple for our clients?
Sure. So the way we do it is it's fully paperless. So you don't need to worry about paper cuts especially. So what you do is you fill in an online form. It'll, based on the information you put into it, it'll generate a drop list basically of all the documents that's needed. So whether it's pay slips, bank statements, or if you're self-employed, your self-employed documents, and all of that comes into the application side of things. They generate up and you can upload them all on the website. Once you upload your documents, like all your documents you get, your bank statements, pay slips, they're all PDFs already or pictures. So all you do is upload them. And then what I do is I go in and I put them all together, basically create a mortgage pack, put them in a certain order based on the lender, and ensure that it's a nice, clean process going forward. So the only required document that you need to get that's outside your control, it's generally just your salary cert. And that's good for 4 months from the date it's signed.
Okay.
So like you can send it off now, have that ready. And then all you're required to do is log into your online banking, click download, get your pay slips and drag them over. And it's a very seamless process that makes it easier for you. So you're not going around, as you said, jumping through hoops to get certain documents.
Okay. So basically, right, what you're saying is we have a system in place that allows you just to upload these onto like, onto your laptop. That makes sense. And just
Yeah.
makes it nice and simple. And kind
Yeah.
of, a bit of a tick box. I think it's like a tick box exercise as well. It just ticks it off as you go along.
Yeah, it'll have the headings, it'll have your name beside it as well to say who the document
Okay.
relates to based on the input. So it's a very smart system that makes it easier for you.
Okay, great. I think like the easy use really is kind of like what I'm trying to get across there with that. Like, and that's so we have a question that came in about that, and it actually resonated with myself as I mentioned. So that's great. Okay, and just one
Yeah.
more question around we're going through here. So just one particular person's asked here for a joint application. Do you need to show a joint savings account, or is a single savings account okay?
So it depends. If you have a joint savers account, you'll need the joint savers. So if the account is open and in your name, that's fine. Some
Yeah.
people combine their finances, some people keep them separate. Some people
Okay.
have all their separates and one joint just for where the mortgage money goes, basically. So everybody has their own different setup. Whether it's single or joint, it doesn't make a difference to the lender because once they can see that that combined couple can do X or Y with their money, then that'll cover them off.
Okay. Okay. Good stuff. Okay. Thanks, Ryan.
So in terms of the mortgage journey now, so there's a few different stages to it. So as we discussed, you go through your application stage. So that's where you submit your documents, have the consult, and you know what you're doing and what you're kind of borrowing. At that stage, it gets sent to the lender. So you're probably looking around 10 to 15 working days for it to be accepted by the lender and a decision to be made on it. So that's when your approval comes back. The approval will be approval of principle with conditions noted. So that what that is, it's a document that allows you to go bidding on properties because you know what you can kind of qualify for. The range is from 6 to 12 months in terms of validity. So they're good for a long period of time. And then to re-extend it, it's a very simple process. It's just updating your documents and you can get that re-extended for another 6 or 12 months. Once you have your approval, you find your house, you find the house, you get the valuation. So what a valuation is lenders will have certain valuers they can accept. Once you do that, I'll talk you through the valuation process and how to get that set up. There is a cost to it, but we'll go through that later on. Once the valuation is completed, it'll come into us confirming what the value of the property is and the condition of the property. If everything's okay on that, at that stage, we'll confirm your loan offer. So what the loan offer or contract, as it's known in some parts, is essentially the legal agreement between yourself and the lender to say, I will lend X amount to the client in order for them to purchase a specific property, and the property is outlined on that. The loan details are confirmed, so your rate, your term, all of that is guaranteed from the loan offer. unless there's a rate change. And then we'll go into that in more detail closer to the time. And then after your loan offer is completion. So that's when you come to me and say, okay, we're ready to draw down. We're good to buy the house. And at that stage, we complete the process basically. So that's when the funds are issued to your solicitor, and then your solicitor completes the purchase on your behalf. And it's up to yourself then when you collect your keys. You can collect them early, collect them late. You can move in before or after. It depends because some people are renting, some people are living on family. So some will be sooner than others going in.
Okay. All right, cool. Can I ask Ryan? So like, and like this is like I think like it's very important to state that like I think like we want to be like along the journey the whole way with our clients, and that we'll be there to help our clients through this. And I suppose from a financial planning point of view, which is what we are with financial planners, it's not just a mortgage journey that we want to help our clients with or help our clients get through, if that makes sense. But like why Ryan would like a person come to us and not go to their bank, for example? Like why would they why would they use us over the bank?
So with ourselves, like we're a broker, we have access would be the main point. So we have 6 different lenders. If you go to your bank, you're only going to get their lending rules and criteria. And what I mean by criteria is basically what they do and don't lend for, what they will and won't do. So with a mortgage, it's essentially just a large risk assessment that the bank does. That's basically what it is. So if we can mitigate risk, then it makes it stronger, makes it easier. And if someone comes to us, I'd have the knowledge of how they review it. We're able to get them what they need based on their current circumstances. Or if that's not the case at the moment, what we can do is we can put them in a position to, in 6 months' time, they'll know exactly what they need to do to get to a certain point. With ourselves, it's a one-stop shop. So whether you're calling up to get your annual review, I want to call with Ryan to check my mortgage at the same time. We have all those systems in place with the mortgage team here. All you have to do is pick up your phone, you get through to us. We have multiple ways of contact, whether it's through phone, email, or even on the online system, there's a message section. So you can have all your mortgage conversations in one place, and it just makes it easier for you to follow back on. So like the mortgage journey is quite long in some cases. If you know what house you're buying, it's usually a bit shorter. But if you don't know what you're buying, it's dependent on what you decide to buy and how long that takes. And the last thing you want to do is trawl through emails trying to find out what I said, who I said it to. So it just makes it a lot easier to where it's a one-stop shop.
Okay, great. And then obviously, like we can get the best of rates as well. Like we're talking there about getting loan offers, loan
Yeah.
amounts, and getting the best loan offer, loan amount for our clients. But as well as that, then it's all about like the correct rate. I mean, like if you get a better rate, it can save you thousands in the long term, really, can't it?
Yeah. So like if you're looking at a first-time buyer, you're looking at 30 to 35 years is usually the term.
Yeah.
If you even think about it, like 35 years is 420 months. So any saving you make is over 420 payments. And that's where the addition comes into it. The saving comes into it. The difference in rates, it's obviously going to be a large mortgage if it's your first, somewhat
Sure.
large. So any savings that are available there, we run through as part of the comparison piece. So I'll compare all 6 lenders in front of you so you can see exactly what each and every one of them will lend, and you will be able to see basically what is more beneficial to you because you understand your situation. And then I'll be there to advise in terms of what the best options are then lender wise in terms of the each different rules, criteria, and so on.
Okay, great. Okay, brilliant. Okay, perfect.
That makes sense?
Yeah, absolutely. Thank you.
Perfect. So the next part is basically just the fees that are involved. So there's a number of different fees that might be involved that you might not think of. So the first one, as I mentioned earlier, is your valuation fee. So each lender has their own different panel of accepted valuers. So the fees can range from 150 euro to 200. You're going to have your legal fees. So you're probably looking between 1,800 to 2,500. Could be more, could be less. It depends on the type of product you're doing, whether it's new build, self-build, second-hand property. Your stamp duty is one where it comes in at 1% of what you buy for, up to 1 million. If you go over the million mark, as you can see at the bottom, it has its own different bands and rates based on that. But that's something we can iron out in terms of an exact cost for you when we're doing the mortgage consult. The structural surveys, it's not mandatory as part of the process, but it is generally something recommended if you're buying a property, whether it's new or not. You need to make sure it's structurally sound. So if you go into your property and you think it's okay, and 6 months down the line, you realize there's a big crack, could cost you thousands. So it's something to look at to make sure that if you're buying a house, you're going to live there long term. You want to make sure that the house is going to stay there long term without any additional cost to you. And then any other fees then are just going to be confirmed at application stage. So what I mean by any other fees in terms of broker fees, cancellation fees, rechanging fees, anything like that, based on your certain product, will determine what fees are actually outstanding. The first four would generally be what's generic across all applications.
So it could be, just to be clear now, because someone has asked a question, there could be a fee for IPF, but we'll be upfront and in letting you know what that will be at the outset of any application.
Yeah, so we'll outline any fees that are going to cost you, but also on your loan offer, it's going to break down all the payments that are required fees wise. So whether it's a commission from the lender, whether it's a fee from you, it'll outline the full cost to you on the loan offer.
Interest
So full
payments included, I
transparency.
imagine.
Yep. So
Yeah,
interest,
that's right.
everything.
Yeah.
So that'll be the biggest one for the first few years,
Yeah.
unfortunately. In terms of additional expenses, so these are other products that you do require. So you'll have your life cover, which is mandatory. So what life cover is essentially mortgage protection is the name for it in the industry. It's life cover for you. So if either one or both were to pass away during the lifetime of the mortgage gets cleared. It's a mandatory product, but it's also a very good product because if you get a mortgage, the mortgage protection in this case, you're looking between 20 to 50 euro depending. So it's health related, it's loan amount related and all of that, but they're willing to clear your mortgage for you. So it's a mandatory insurance, but it's a very good one. Home insurance, again, mandatory. So you need to insure the property for what it's going to cost you to rebuild it. Based on that, then that'll determine the cost of it. But again, you'll never put into these products what they're willing to pay out. So that's the main point to actually take out of it. I hope you never have to use them, but it's nice to have them there. Contents insurance, it's not mandatory, but it's generally recommended because your own owning, your own assets, your own jewelry, clothing, all that sort of stuff has a value, whether it's monetary, sentimental. You want to make sure they're covered and you're looked after. And then you'll have the income protection piece. So Colin would generally look after the financial planning side of things. So I think I'll let you speak on this.
Yeah, like I think income protection is it's not required by your lender, whereas obviously we have the life cover and mortgage protection. It is absolutely required by your lender. We actually have a question of when it's required. It's required at the point of drawdown of the mortgage, is my understanding. But when it comes to protecting your income or attaching some serious illness benefit, we would always recommend that you do so. Just to protect, like this is going to be the biggest purchase you're ever going to make. Your biggest asset is your salary. And we recommend, protecting a piece of your salary that's going to allow for you to be able to maintain your mortgage repayments, even if it is a case that you're unwell or you can't work due to illness or injury. So this is something that, like from a financial planning perspective, we can go through with anyone in this position from the point of view of when they're buying their home and they want to actually make sure that they're protecting their biggest assets, i.e. their salary, i.e. their home.
Yeah. So one of the points I've realized over my journey, basically in my career, is that the majority of people, you probably know this better than I do, like when would they regularly ask about income protection? It's usually after.
It's usually, unfortunately, right? It's usually after something's happened either to them or a family member. If something has happened to themselves, it can be difficult to get that protection, if that makes sense. It can be difficult to get income protection, which is not ideal for people. So look, we usually recommend to people, look, when you're young, you're fit, you're healthy, the income protection is cheap. It's the backbone of any financial plan, and it protects the overall plan, if that makes sense. So while you're young, fit, healthy, it's cheap, it's easy to get. There's tax relief on income protection payments as well. That's the time to go and get it.
Yeah, perfect. And then just to kind of finish up on the presentation side of things, these are a couple of do's and don'ts. Now, I'm sure a lot of you know it already, but I always go through them anyway because it's just to make sure. So the main thing to do is pay your bills on time. Don't miss direct debits. Whether that's transferring money between accounts, that's fine once you're covering your bills. If you set yourself a budget to save, so the main point of the mortgage piece and over 6 months, they want to make sure you can do it over a long period of time. And that's why they do it for 6 months. If you're able to save a regular amount each month, that gives ease to the lender, basically, that you would be able to afford that per month. And then reduce your credit. But I'd only recommend doing it if it's possible without stressing your account. So I don't want you making as much as you can in terms of overpayments on credit cards or overdrafts. Provided you're making your payments on those, that's the main point. If you can reduce them, do, but don't stress yourself to do so. And then the main don't is don't dip into your savings. So the reason lenders don't like that is that it makes it difficult for them to know exactly what you can save each month. If you get new credit like a loan or a credit card, that's going to have an impact on your application. Like the last thing you want is to get a small loan for a little holiday and that to be the reason you don't get your dream home. if you change jobs if possible. So the reason I put that in there is that most lenders won't let you draw down a mortgage while you're on a probation period. So your probation period can be between 6 to 12 months. So if you change job, that's probably going to have a massive impact on your application. And then it's the cliche, it's the gambling. So don't allow it to show on your accounts. If you do it, you can do it within means, but it generally is recommended not to be on your accounts because it doesn't show good management of funds if it's a regular occurrence. And then the final question, Colin, do you want to jump in here?
Yes. Okay, guys. So the question is how much do you want to, I think yeah, come on. Yeah, there it is. What is the maximum first time buyer can borrow? So we have the chat function open. So I'm just going to let you go to that. So anyone has the answer for a €100 voucher? I'll just make sure I'll open this to everybody. So it's open there now. So what is the maximum a first time buyer can borrow?
And I'm not allowed to enter, no.
No. So the chat is open, guys. Anyone can.
Perfect. So we can go through a couple of Q&As if you like while the answers come in.
Yeah, okay, cool. So I'm trying to make sure it's open to everybody. We're having a bit of trouble with the chat function, unfortunately. Okay, great. We have a winner. So I'll announce the winner. So Monta Termain. So congratulations, well done. The answer is, want to go to the next, if you want to go on, right?
Yeah.
Put the answer up.
So the answer is, of course, 4 times your salary.
4 times salary. So Monta Termain. So Monta, if what we'll do is we'll send you, we'll get in touch with you and we'll arrange for that voucher, €100, for that voucher to be sent out to you. So well done, congratulations, and thanks for everyone who took part there in that competition.
Great. And just one point I want to touch on. I noticed there's a lot of questions coming in relation to recently moving to Ireland. So the way it works with lenders for either non-residents or new to Ireland or non-Irish people in Ireland is you do need to be allowed to live and work here. So whether that's through an Irish residency permit, so an IRP or GNIB is what it used to be called, or whether you're an EU citizen, you can still get a mortgage. So if you're an EU citizen, then you can apply directly because you don't require a residency permit. If you're from anywhere outside, so the normal ones would usually be like South America, Asia, Africa, and stuff like that. They'd come over, they'd have an IRP card. So there's a few different ones. So you'll have your stamp 1 and stamp 1G is what you start on. And then once you go from that, you'll go to stamp 4 or Irish resident or Irish resident afterwards. So once you have a stamp 4, that's when you can apply. If only one of a joint party has a stamp 4, then that's still accepted. But if it's 2 people on a stamp 1 or stamp 1G, they wouldn't be in a position to lend. There might be an option. So with the access to our lenders, we can always check the criteria to see if it changes, but it's up to them based on that.
Okay, great. I think we're just running out of time here, so we're kind of keeping people a bit more, so we might just move on. Ryan, I think we're nearly done, are we?
Yeah, so it's essentially the final bit is what happens next. So what happens next is this is when you schedule your quick call. So it's a 5-minute qualifying call. So what I mean by that is that I'll have a quick chat with you to see whether you want to go through the consult or whether you want to go through the preparation call. So there are 2 different meetings for obvious reasons. One's getting ready and one's starting the application. So if you scan the QR code, pop your details in, the emails come in, and I'll be able to contact you to go through what's next, what the next steps are based on your current circumstances, or to answer any queries you might have.
Okay. Great stuff, Ryan. Anything else that we need to touch upon?
I'm not sure. I'm just having to flick through the Q&A there. Do you have any other questions that come up for yourself?
Maybe if we take a quick look and answer 1 or 2 more questions.
Sure. So I see their bad credit rating was popped up. So credit rating is an important one to do. It's very important because it's one of the main parts that a lender looks at. If you want to do your own CCR, so your central credit register, you get 1 free a year usually. You can do a check and you can see what the lenders see. So you might think there's something showing up, but it was so long ago that it actually doesn't show up. Or if it's something that shows up, a lender still might accept it. It just depends specifically on what it is. So what you can do is if you request your CCR, scan the QR code, I'll be able to go through what options are available for you.
Any other questions there you think might be relevant?
I think I've touched on most of them. In terms of anybody that's still on probation, you can still apply and you can go to the AIP stage, to where you get your approval in principle. And then afterwards, all you do is send in a letter confirming the probation's over, and then you're good to go.
Okay. Okay, guys, we will leave it at that. I think we've taken up enough of your time. Please go enjoy the rest of your lunch. Thanks for tuning in today. I hope you got something from it. The QR code, as you saw, was there. We'll be sending out the presentation as well in a link, so you can always take a look at it at a later date as well. Okay, Ryan, thanks very much. Well done, fair play. We'll leave it at that.
Cheers. Thanks again.
All the best.